You're about to join Jerry Parker, Moritz Siebert, and Niels Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver, Moritz Siebert, and I, Niels Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Now, for those of you who are regular listeners, our conversations are, of course, intended to keep you focused, inspired, and motivated to continue your rules-based investing journey. And if you're new to the show, we hope that today's episode will trigger some level of curiosity to check out the back catalog and listen to past episodes that you may have missed. Rob Moritz, great to be back with you this week. How are things where you are? How are you doing?
Yeah, doing well. It's a bit wet and soggy here in not very sunny England, so it's been quite funny. I've been setting up meetings with people and saying, yeah, it's going to be at 3 p.m. British summer time, but it doesn't feel like summer here, that's for sure.
Hey guys, I'm fine. Weather's improving and nothing to really complain about, so all good.
Very good indeed. So, I mean, just as a quick summary, as we always do, it was a bit of a crazy week, certainly in U.S. politics, with, of course, the presidential election debate, which I don't think we need to talk about. And, of course, now with Donald Trump and the First Lady contracting the coronavirus. And this morning, Trump apparently has been hospitalized. So with that, U.S. stocks came a little bit under pressure yesterday, following the news with a slight down day, but for the week, it actually managed to put in about 2% advance and is still up for the year, about 4% if we look at the S&P. Grains were firmer for the week, as was the metals. Energy took a bit of a hit, and bonds and the US dollar were slightly soft. Now, in the news, just a couple of things that might inspire some conversations later on today, but I couldn't help to notice what's going on with the small trader call buyer index. So this group, as a percentage of total volume, pushed to 46% during the week of January 17th of this year. And that was actually the highest reading since October of 2007, where it registered 47%. And of course, we know that call buying levels in October 2007 did coincide precisely with the beginning of a 54% decline in the Dow Jones. And of course, in our case, less than a week after that recording in January of this year, the Dow hit a closing high of about 29,550 on February 12th, and of course subsequently experienced the steepest decline from an all-time high on record. So last month, during the week ending September 4th, which does include the day where the Dow made its latest high, the small trader call buying index pushed up to 53% of total volume, and that surpasses both the prior record of 2000 and of 2007. So maybe this little indicator is some kind of a precursor of what may follow once we have the U.S. elections past us. But it wasn't just in the call buying area that we saw some interesting numbers and extremes. In fact, if you look at the US IPO market, August actually reached a new extreme with 43 offerings, the most since August of 2000, which of course was the last high in the greatest IPO boom in history. And just to round that off, the Wall Street Journal actually described that wave of new IPOs only a few days ago with a headline, IPO market parties like it's 1999. So there we have it. Some flashback to the last, or not the last necessarily, but one of the bubbles. Any bubbles going on in your performance, Moritz, this week? Or maybe it's a computer bubble?
Yeah, computer bubble. I haven't run the numbers yet, but I do remember that I looked at it, I think on Thursday morning. And on Thursday morning, I was up 60 basis points, maybe a bit more even. That's what I remember. So I think I've had a positive week because I don't think that I've lost 60 basis points yesterday. I cannot tell you which markets were driving the party in air quotes. I mean, it's only 60 bips, but, I've had a couple of weeks kind of like almost in a row where it's down 50 basis points, down 20 basis points, down 50 basis points, just grinding lower. So this feels good. It's a bit of a relief. I'm happy about it. And I'll be happy to put into the show notes what the performance drivers were.
Sure, absolutely. Now, Rob, as usual, it's always interesting to have you back and hear what's going on in the last month or so. Of course, September as a whole was so far the worst month for CTAs in 2020, certainly for the broader index and trend followers in particular. So since that month has just come to a close, how was September on your side?
Yeah, I didn't run the numbers for September exactly. I ran them from the last time I was on, which was at the end of August, up till yesterday. So there's a couple of days of October in there. So it might not be an exact like for like, but actually for me, it was a very good month. I was up 4.6%. And the gains really were in things like Italian and French bonds and German bonds, interestingly, and Korean bonds, with a couple of other markets in there. So very good in bonds. Of that 4.6%, basically, it was all made in bonds, with just a little bit of kind of random contribution across the other markets. So that's interesting. And just for a kind of a comparison with you guys, just looking at the last week, that was actually, for me, also a probably similar performance to Moritz once you've taken into account the fact that we're running at different risk levels. So I was up about 1% last week. And actually, the pattern of gains is very, very similar. So a lot of good performance in the bond markets, not so good in say, the agricultural markets. But yeah, it does feel a little bit like a kind of calm before the storm. And I'm sort of hoping that my system doesn't decide to build up any positions that are too big over the next few weeks, because it does feel like volatility is going to get pretty interesting.
Yeah. And we do have that bump in the VIX term structure still around the US election. So it's not just you who are expecting maybe a little bit of excitement around that time. Now, when you talk about your performance being strong and all of that, that's not just pure trend following, right? That's also some of the long only side of your portfolio that kicked in well, or
that's my futures trading, which is probably about 30% carry, 60% trend following, and 10% some other little bits and pieces. But okay. Yeah, it's a kind of reasonable trend following proxy. It's probably got a correlation of about 70 to 80% with the big trend following indices.
Yeah. Okay, cool. So, I mean, on our side, very similar to what you just described there, Rob, last week, similar performance in terms of a quote unquote a small up week. Certainly, we benefited mostly from the weaker energy prices that we saw, as well as the soft dollar. And then other sectors were somewhat muted overall. And we gave back a little bit in our volatility strategy last week as well, but nothing really major. Now, we got a couple of topics that you wanted to bring up, Rob. We got a few questions as well from Chris and Robertos that we need to dive into. Some good ones. Some of them also, or one of them will be familiar to our listeners in terms of the topic. So that's going to be exciting. And I've got a couple of things that I noticed as well. And of course, Moritz may also have a few things. But why don't we kick it off with you, Rob? There are some things that, since you're not here every week, let's give a lot of airtime to some of the things that you find interesting at the moment.
One thing one thing that really annoys me, if I'm being honest with you, yesterday morning when we did hear about the sad news about the President of the United States and his wife, I remember there was a news flash saying, the markets are panicking and the Dow is down 500 points. My stomach churned. I was like, oh my God, 500 points. That sounds absolutely terrifying, absolutely enormous. And then my kind of rational brain kicked in and said, what 500 points, what does that actually mean? And I quickly Googled, what is the level of the Dow? Because, of course, I suppose one of the interesting things about trading purely systematically, I do try not to look too closely at what markets are doing on a day-to-day basis, which means I don't necessarily know what the price level is of every index that I'm trading. I could probably tell you what the FTSE is roughly because it's the kind of home index in the UK. I could probably tell you roughly where pound dollar is because that's quite important to me. But a lot of other levels I couldn't even tell you. And it wasn't until I checked that I realized that actually 500 points on the Dow, I think, worked out to about 1.3%, which, is a kind of a reasonable size move, but it's probably roughly one standard deviation, something like that. And I think it's an interesting topic to think about because one of the things I think we try and do in our trading systems is sort of standardize everything so that we can be thinking about things across markets, comparing things across markets, without having to be constantly translating things into percentages and then into vol scale returns and all this kind of stuff. And I don't know, it's just a real pet hate of mine when people report market moves in points because it's just completely meaningless. I don't know what you guys think.
Well, it got your attention, which of course I'm sure is the whole point, right? When you see that flashing red number saying, oh, Dow down 500 points. And of course we know, and I think this is also why financial podcasts have become so popular, frankly, is the fact that I think people are generally getting bored or even tired of the way news are being reported. And I'm not just saying the financial news, but clearly some of the mainstream media, they just thrive by throwing out negative news and things that will essentially, fear sells better than anything else. And also, we know our friends over at Real Vision, they have become a real alternative to some of this media. And so I think and this is also what we're trying to do every week is, of course, we're trying to talk and educate and report what's going on, but without the fear mongering. So I share your sentiment, but I've kind of already gotten to the point where I don't even turn on the television to watch that headline.
I think we've touched on that before. I mentioned it a couple of times. I'm just as annoyed as Rob is about this. Probably was in the fall of 2018 when we had the correction in the equity markets, and there's CNBC and Bloomberg saying the Dow is down 700 points and the S&P is down 150 points. It's like, what does that even mean? It is really bad reporting, and I think they know that. I think they know it and they still do it because it is exaggerating and it gets people to maybe panic, but they take the wrong conclusions. It is not the way that anybody should be looking at markets and returns. Just use a percentage return and it keeps you a lot calmer. That's, by the way, what I do with my trend following system or with my trading in general, right? If I looked at a P&L, like a daily P&L in dollar terms, right? And it's more like than say 10,000 or 20,000, or sometimes it happens. And it's like, you feel crap. You feel really crap. You've lost a bunch of money. But, if it says, oh, yeah, you've lost 0.5 or 0.6% of your portfolio in a given day at 20% vol, then it's kind of like, well, what's the big deal? I should actually expect that to happen every day or every second day. So it's not a problem. It's just doing what it's supposed to do. And I think this is important to not look at it the wrong way because it gets you on the wrong track. I think we're not preaching to the choir here. Probably CNBC isn't listening to our podcast, neither is Bloomberg. I don't think that's going away. Like I said, they probably know that they're doing it. They know it's wrong because the people that work there, they just cannot be that stupid, right? But, it's the commercials, it's the business, this is just the way they want to run their business. Okay, fine. They've lost us as their viewers because we're no longer watching them. But, well, maybe there's a couple of people still out there who enjoy that.
Yeah, I think that's really good advice, actually. A piece of advice I often give to people is if you want to become more removed from your trading and try and be more rational about it, is only ever look at your returns and percentages. Don't look at it in money terms. Because when you've got, if you get to the point where you're lucky enough to have a decent sized account, those daily swings, they can easily be 4 or 5 figures, which, is a lot of money. But of course, it's mostly random on a day-to-day basis, but it's really hard to tell yourself that. It's really hard not to be elated when if you've made a 5-figure profit, or really annoyed if you've made a 5-figure loss. But then you look at the percentage and it's not too bad, actually.
Yeah.
So you say when you're looking at your own trading returns, you do it in percentage terms. When you're looking at, say, market performance, so let's say maybe it's for an internal meeting or you're trying to present to clients a monthly report and you're saying, right, this is kind of how the markets did over the last month or something. Do you go a step further then, and I almost hesitate to introduce the V word this early in the conversation, but there we go. Do you go a step further and vol adjust those returns so they're meaningful? So you can say, okay, yeah, Eurodollar's moved like 0.02%, but actually that's 3 standard deviations. S&P moved 2%, but actually that's only half a standard deviation. Mm-hmm. Or do you think that that's a step too far?
Yes, I know exactly what you mean, and I like the idea. I actually don't do it in vol terms. I do it in ATR terms, which, it's kind of like it's bringing across the same point, like, how many ATRs did a market move in a given week. But internally, I don't do that with our client. I mean, we don't have that many meetings about the performance. But what I do, and this is, I think, a chart that they enjoy, and I'm happy to share it with you guys, is for all the markets that we have in their portfolio, on a monthly basis, I just plot bar charts for their monthly performances, and I rank them from highest to lowest, right? So it starts with, I don't know what the best performing market was. Maybe last month it was silver. I don't know. It went up, it crashed. I don't know. Where it goes from 1 to 50 or 55. And then on the same chart, on the secondary axis, I plot the contribution of the market in my system. And that relationship is kind of interesting, right? So if silver has a plus 20% month and the system is long silver, and then on that same bar in a different color, I can show, well, we've made 2% off of silver, then that's cool, right? If we have the wrong position on, then it's going to be a bar into the negative territory, and everybody immediately knows that we're short instead of long. And this is one of the charts, even though it is a simple chart that, at some point I just came up with, it got the greatest amount of applause for whatever reason. It's just, that's what they like to see. So we continue to do that. But I don't overwhelm them with, we've made, I don't know, 7 ATRs in silver or something like that. It's just too much explaining going on. But we have that internally at the quantitative research team. We kind of we speak that language. We normalize everything into ATR space or volatility space, if you will, because otherwise it's, again, a meaningless number. Whether you've made, I don't know how many $1,000 in weed or that many percent in weed, it doesn't really mean anything if what your system is doing is, looking to take the same amount of risk across all of the markets. So I'm more interested in how many ATRs did that market move and how many ATRs P&L did it contribute to the portfolio this week, this month, etc.
Yeah, that's quite a cool way of doing it. I guess the other amusing thing is if you do everything in vols, then eventually there'll be some kind of crash and some poor quant will be asked to report on it, and he'll say, well, it moved by 18 standard deviations, and everyone then of course will be very mean to that quant and say how silly they're being by saying that's something that's only happened once in the history of the universe. So I think we should be careful about using vol adjustment too much in the kind of public facing, because not everyone understands that. Most of us do understand that a vol adjustment is only an approximation that assumes Gaussian returns, blah, blah, blah. And
correct. By the way, I just got my numbers. I'm up 77 basis points with the largest contributor being iron ore, followed by OJ, that's orange juice, and wheat. And what you just said, Rob, at the beginning of the conversation actually got me thinking about, you said, roughly where the FTSE is, roughly where cable is, because those markets are meaningful or important to you. And I guess everybody has their handful of markets, or maybe the 2 or 3 markets that they look at and where they know where the prices are, right? And, for me, for whatever reason, I can be pretty exact about WTI crude oil front month contracts. That's 37. I don't know why it is, but I look at that multiple times a day. It's just a habit of me. There's really no reason I should be looking at wheat and corn and iron ore and the 10-year Canadian and the Korean bonds in the same way, but I don't. If you ask me where the Korean bond is trading, or where BTPs are trading, or where canola is trading, or any of that, I wouldn't have a clue. Not even ballpark. I mean, maybe a little bit ballpark, but it's...
Is that because you have a car that uses a lot of gas?
Exactly. The Ferrari uses a lot of gas. No, I'm just kidding. It's just a habit, right? And yeah, I can roughly tell you where the DAX is trading, and probably the S&P. But if you ask me about the NASDAQ or even the Dow, well, I don't know. I look at the 10-year US, I think that's around 126, but some of the other markets, I really don't have a clue. Gas oil, no clue. Sugar, I don't know. but it doesn't matter, right? It's just, it really isn't important to know where those things are trading.
What about you, Niels? What are your markets that you actually can follow enough to be able to quote the price?
I would say I probably follow a few more markets than it seems that you two guys are doing. But of course, there will be markets where you're not that entirely sure. But maybe also because if you do look at your kind of your signal sheet every day just to see where things are and so on and so forth, you know, some of these numbers do register with you. So you're not completely surprised when you look at the screen once in a while and see where it's trading. So the thing is, and I think this is a very important point, I do think that on one hand, and maybe it's because I actually started as a trader, not as a systems trader, but as a real, you know, trader, having to make decisions based on, you know, no rules. So markets, I would say, are still of great interest to me. I find it fascinating. I find it fascinating with what's going on and what I think may happen going forward. Although it doesn't impact me, of course, in terms of how I think you should be trading. I think following rules and trend following in particular is the way forward, no doubt about it. But I find it interesting and fascinating. And I also find, you know, history of markets and bubbles and manias and all of those things really something that just helps give you some context at the end of the day. I know some people are much more focused on just follow the rules. That's fine. And that is, of course, from a trading point of view, the right thing. But I don't think you need to, you know, not pay attention to what goes on around you. I think that's perfectly fine. But yeah, good stuff. What else did you have on your side, Rob, that you wanted to dive into today? As I said, there are a couple of questions that will be quite specifically for you is one of them, and maybe for Moritz the other one. But we wanted to get some of the topics dealt with that you also had brought up.
Yeah, I just thought it was interesting that Moritz was having computer problems this morning. I was having computer problems yesterday, which I was discussing with Niels before we came on the air. And actually, I was having more computer problems last week trying to get my wife's laptop working, which runs under Windows, which is an operating system I absolutely loathe and spend as little time as possible with. But it kind of got me thinking because I think the thing people find most disappointing when if they're, you know, lucky enough to meet me in person and be invited around to my house, which is not like a general offer to the people listening, is the, you know, to see, you know, the trading room, which basically consists of a couple of computers in a dusty corner linked to a router with no monitors or anything like that, and my kind of little 14-inch screen that I'm looking at now. Because, you know, they're expecting to see the sea of monitors and all this kind of stuff. And I just think it's kind of interesting for people to understand the difference between systematic and discretionary trading. And one is in the way that we use computers, isn't it? Because although our infrastructure has to be robust, absolutely robust, it doesn't necessarily have to. It's a surprising thing because we probably use computers in a more sophisticated way than the average discretionary trader, right? But ironically, I would imagine that we probably have much poorer computers in some respects, certainly in terms of the number of monitors, than those guys tend to do. I don't know if you guys ever had that. I don't know how many times you've had people like breaking into your office to meet you because they're so excited to finally see the faces of the podcast and then being very disappointed at not seeing like a wall of monitors. Is that an experience you've had as well? Or?
They don't come to my office, but of course I have 24 different monitors on the ceiling, on the sidewalls, back and forth.
Yeah, I mean the listeners can't actually see Moritz's webcam, but I can tell you that is actually not true.
Exactly. I wouldn't know what to do with them. But what I did, and you know, I upgraded my screens during the virus lockdown, and I had two 24-inch screens next to each other for the past 10 years or so. I think I purchased those in 2009. And they were still perfectly fine. I mean, there was absolutely no problem with those screens. They were still working. But I was just, I'm looking into these screens a lot during the day, and I wanted to have a 4K HD, larger screen. So I purchased two 32-inch monitors. I'd say that was money well spent. It is money well spent. I enjoy that much more. I can see it better. It is much clearer. It is an improvement, right? So that is, but that's the only investment that I made in terms of IT technologies in many years. For the most part, I'm running things off of a laptop. Laptops have become so powerful. They cost a little bit of money, but they've become so powerful that, I don't really need a stationary computer anymore. And I enjoy having a laptop because I can, can carry it around. If I need to go somewhere, I'll just, pick the thing up, put it into a bag, and off we go. So it is really, really not much. Keyboard, mouse, laptop, two screens. That's it. Nothing special, really.
So if we want to go down that route, which is obviously something we don't really talk about that much. So I guess I have then a slightly different setup. But I actually like both of you. I think right now when we're talking, it's all happening on a laptop. But because we, when you do a podcast, you actually need quite a bit of information in front of you of different sources. I actually did go out, maybe it was last year, to buy a larger monitor that I can just attach to the laptop. So I'm right now looking at a 49-inch monitor, and all I can say is that's actually too much, because you have to kind of turn your head in order to see from one side to the other. So it wasn't quite what I expected, but it does allow me to put all my notes and my programs that I need open to have these conversations on one screen. So in that sense, it's quite nice. And frankly, nowadays you can get these monitors for relatively reasonable money. But I think it's a little bit too much. I probably would find something around, 40-inch, I think would be a good size that still allows you to have almost three full screens in front of you.
Yeah, I mean, those screens, when I looked at the thing, they tend to become exponentially more expensive the larger they get, right? So a 48 or 50-inch screen is substantially more expensive than two 24-inch. A 24-inch screen probably is $150 or $200. They really aren't that expensive anymore. And I got the 32-inch screens. I mean, we're getting off topic here, but they were like, $350 or something like that. Whereas if you wanted a real good, like 50-inch screen, they're probably more than $1,000 or something like that. But it's a matter of taste. I think, when you spend a day or when you spend a lot of time in front of a computer, you must have a setup. At least I want to have a setup that is not annoying, that allows me to, do the work and not be. I just want good equipment. It's more fun that way. So I think for me, that's money well spent. But I don't need 8 screens.
Oh, I mean, Niels might need it because he's got to track all these 50 markets he's actually looking at the prices of, right?
Exactly.
Yeah.
Right, there we are.
It's interesting, isn't it? I think for me, what's more important is the kind of horsepower of the machine I'm using, because I need to run back tests, which, can computationally be quite an intensive process. I mean, do you guys do that like locally in your laptops, or do you kind of virtual machine into a cluster or a cloud server or something like that? Or?
I used to do it, Rob, on AWS and on Azure. I had both instances running on AWS and Azure. But I didn't do that for the backtesting and the parallel computing there. I had this kind of like as a setup where I thought, well, that's a good thing to do. I just access the server from wherever I am in the world. And the only thing I need is a tiny laptop. And that laptop doesn't then have to be that powerful. But I stopped using that setup because, I need to, patch these things and run updates on that stuff. I need to get Bloomberg running on the thing. Sometimes on the server instance, it's not that straightforward to do because ports are blocked and, things like that. And what I ended up doing is buying a more powerful notebook. So not one of these, 900 or $1,000 notebooks, but one that is substantially more expensive, but has a lot of horsepower. It has horsepower akin to a stationary computer. And that works perfectly for me. And ever since I'm using that, it's also fast enough for me. I have no problem with that.
For the things I do in terms of backtesting, it's on AWS. So there we are. But it could be done on a local machine as well, I would say. definitely.
Yeah, I kind of went down the same route as Moritz. I've got a pretty powerful laptop. I have toyed with the idea of setting up almost like a local cluster, because I do have quite a few spare machines lying around, because I have a bit of a habit of buying computers. So
I hope your wife is not listening to this.
I sincerely hope that she isn't. Yeah, I've hidden them mostly away in random parts of the house. But yeah, I mean, the cloud stuff's interesting because I actually run my trading system, which is fully automated locally. And probably every week someone says to me, why don't you run it on the cloud? And it is one of those things that I've kind of thought about doing, but there is quite a lot of a fixed cost in terms of hassle of getting it working and then a little bit of ongoing cost in making sure it works. So I haven't gone down that route, but it is always an option I've thought about, I have to say.
So now we discussed the media. We talked a little bit about a topic like how do we what screens are we using? I wasn't expecting that one today, but there we are. What's your? I think you had one more topic you wanted to bring up, Rob.
I did, but I think it would be more fun and perhaps make more sense if we had the questions for next, actually, because my topic may segue into one of those questions.
I'm sure it will. Okay, cool. All right, well, let's jump to the question. So the first question is from Robertos, and who very kindly starts out by saying that he wants to thank us for the hard work we're putting into this podcast. It is the highlight of my week when I see it appear in my feed. So thanks very much for those kind words. Now, your favorite topic, volatility targeting. In Rob's book, Systematic Trading, there is a chapter 9 on volatility targeting. Volatility targeting is one of the building blocks of the framework that is laid out in the book. It would be interesting to hear how Rob explained this building block of the framework and Moritz's take on it. Question 2. I understand that you all trade futures contracts, but I would like to do that as well. However, being a retail trader with quite a small account, I cannot achieve the desired diversification with futures. This is why I adapted Rob's framework to trade leverage ETFs. I read in his books and heard him mention that leverage ETFs should not be used. Could you please expand on this? What are the reasons? I've been trading this strategy for 2 years already, and I did not see any issues, but maybe I'm missing something. I should be careful. So those two are the questions. Let's dive in. Rob, over to you.
Yeah, I should first say that I know it sounds a bit suspicious that someone called Robertos, which is obviously a very similar name to mine, is written in saying how great the show is and how great my books are. But I can assure you it's not me.
I did notice that.
Yeah.
Yeah.
If I was going to do that, I would have used a less obvious alias, perhaps. Yeah, so I'm struggling. I'm glad that he mentioned what chapter 9 was about, or I would have been faced with the prospect of having to grab a copy of my book from the shelf and desperately try and remember what was in chapter 9, because, this is a book I wrote over 5 years ago now, but it is indeed about vol targeting. I mean, we have talked about vol targeting at length, but in an abstract sense, the idea is that there is some level of risk that you want to achieve either on a particular position or on your trading system overall. We can get into a debate about how risk should be measured, how different people have different tolerances to risk and so on and so forth. I like to keep things simple and basically assume that the world is not like it is, assume that returns are Gaussian, and therefore that one can use just the second moment of the distribution, which is a standard deviation, and use that as a way of both expressing what someone's appetite for risk should be, but also how you should measure risk of the instruments you're trading. So the thing you have to do is firstly come up with an appropriate target risk that you want to achieve, and there's a number of elements that go into that. The first is, and definitely the most important, I would say, is this thing we talk about quite a bit, which is some way of saying, given the performance of my system, what is the optimal level of risk I should be running at? And, a lot of people, including myself, use this thing called the Kelly Criteria. The Kelly Criteria basically says, given some level of performance or expected edge, betting edge, gambling edge, how much money should you be putting into your bets, for example? And there's a kind of fixed version of this, which I actually use myself to do. I do a little bit of kind of gambling in the political markets on the side. So I put a bit of money in the US presidential election, which Niels and I were actually discussing before we started. But there's also a kind of continuous version of it you can use in your sort of normal trading system. And the other thing to say is that you have to make a lot of assumptions which probably aren't realistic to use the full level of Kelly betting. And so most people use a lower level than this. A lot of people use the half Kelly, which means you just take the risk target and cut it in half. I do something a little bit more sophisticated, which is to look at how much confidence I have in my estimate of what the Kelly criteria should be, and then basically take a conservative point of that distribution. So I'm basically saying this is a level I should run at, given that I'm kind of 70% confident that my system performance is at this level or higher. That will normally be the kind of constraint in determining what your risk target should be, but there are other things as well. So there's your own risk appetite, how much risk you can cope with. And we discussed earlier about how, if you're running a reasonable sized account, the swings in money terms can be quite high. Percentage terms don't look too bad. But if you ramp up your risk too high, even those percentage swings can look quite scary. And a lot of people who think kind of intellectually they can cope with that kind of risk, the moment they're actually running it in a real life trading system, they realize they can't. So I generally advise people to start with fairly low risk targets and then increase them gradually as they kind of get comfortable with what's going on. And then there's a couple of kind of external constraints. So, exchanges and brokers won't let you use infinite amounts of leverage. There's normally regulatory or margin limits on those. And it's also sensible to incorporate some kind of factor accounting for the fact that returns are not Gaussian. And I call this the black swan factor, which is a name I stole off somebody else, a guy you might have heard of, who writes about black swans a lot. I guess he's some kind of expert on birds, maybe. I don't know if the listeners of this podcast know the guy, but yeah, black swans specifically. But the idea is that you say, well, given some really bad market shock, what kind of level of drawdown would I be comfortable with in that market shock? And from that, you can imply what your maximum leverage limit should be and your maximum risk target should be. So so all that, you put all that together, and basically that will tell you what level of risk you should be targeting. And then the next thing you need to do, which is probably a lot easier, is just to say, well, I like to, when I'm talking to students about this, I like to say, right, you're walking into a shop to buy some risk. You know how much risk you want to buy. You then have to look at the shelf and see what's on the shelf and how much the price of that risk is. So let's say I want to buy $25,000 of annualized risk. I walk into the shop and the first thing I see is the VIX contract. I need to measure have some forecasts for estimating what the volatility of the VIX will be. I need to translate what that is into dollar terms. And I'm going to just say a figure because I don't actually know, but say that each contract of VIX has $1,000 of risk attached to it. So then I go to the counter with my $25,000 and say, I'd like to buy 25 VIX contracts, please. And that calculation will be different depending on exactly what it is you're buying or selling. So that's the core of the idea. And there are further things about, for example, should you change the risk depending on how confident you are about your forecast? Should you, when you're allocating risk across multiple instruments, should you just divide it equally? Should you account for diversification? There's a whole bunch of stuff we could talk about. But the core idea is the fact that there is some risk target you're aiming for, and you can then basically go and buy up that amount of risk by measuring the risk of the things you're trading, and then that determines how many of a particular instrument you want to hold.
Before we jump to Moritz, do you want to expand a little bit on the point that Robertos make about the leveraged ETFs and what he may have to think about that is of concern to you, it seems?
Yeah, I was going to come back to that later, but I hadn't forgot about it, honestly. I just thought that would be a separate question. But I think it's important that people understand how leverage ETFs actually work. And the way that they work is potentially quite unpleasant because you can hold a leveraged ETF, and over time, think that you're going to be making money, but actually the leverage works against you and potentially loses you a lot of money. I mean, the general advice is it's okay to hold a leverage ETF for a couple of days, but holding them for a long period of time, you really suffer from the fact that, I'm trying to think of a way of putting this in a simple numerical example, but the basic maths is something like, let's say that the market has a bad day and is down 3%. If you own a 2 times leveraged ETF, you're going to be down 6%. So now you've got $94 where you used to have 100. To get from 94 back up to 100, it's not, you don't need to make just 3%. You actually need to make more than 3% to get back up to 100, because 3% doubled 6%. 6% of 94 is not 6. It's less than 6. I can't be bothered to work out what it is, but it's less than 6. And that's fine over 1 or 2 days. But as that continues over time, if things are moving against you, your capital can be wiped out really quickly. And in fact, we did see this with leveraged oil ETFs way back a few months ago when we were talking about oil a lot. Maybe that's where Moritz developed his obsession, I don't know. Or maybe he's always had it since he was a child, I don't know. But there was kind of high-profile cases of leveraged oil ETFs being shut down for this very reason.
And actually, it's also something we see in our industry as a whole, because some managers will offer products with different level of leverage, but it's the same strategy. And they don't actually, for the same reasons, I mean, the math when you're in a drawdown, there's a difference between being in a 40% drawdown and a 20% drawdown when you have to recover. So there will be small differences on that as well. But I think your point is well taken on the leverage ETF.
Sorry, just quickly, it actually links back to the idea of the Kelly Criterion, because by taking on too much leverage, you're quite possibly pushing yourself beyond the optimal leverage point, which means that the Kelly Criterion says you'll actually end up losing money, even if the underlying asset is actually profitable. Just thought I'd mention that, sorry.
Sure. Moritz, what are your thoughts?
A couple of thoughts on that. Let's start with these leveraged ETFs. I think the issue with the leveraged ETFs, 2x, 3x, and then there's inverse versions of that as well, is the mean reversion tendency, the propensity of markets to mean revert, right? So as Rob was saying, if you hold them for a couple of days, the damage is kind of controlled. But if you hold them for a longer period of time, then you will suffer from the fact that markets every once in a while have a mean reversion tendency and they do not trend, right? So you have an exposure to a leveraged ETF, say the market, to make a simple example that we can actually calculate without doing 6% times 94. If the market goes up 10%, you're at 110. If it goes down 10%, which is exactly the same percentage return of the following day, you're not at 100, you're at 99. And that works in the exact same way in the opposite direction to the downside. Now, if that happens a couple of days in a row, right, you're up 10, down 10, up 10, down 10, up 10, down 10, then you don't end up with 99. You end up with probably something around 97 or something like that, right? Now, 10% is a very, very high number. You see it maybe in the VIX, right? And we had the XIV meltdown on February 5th or 2nd of 2018, where, a 50% increase. No, I think in the XIV it wasn't leveraged, so 100% increase, 100% percentage increase in the VIX, which is what happened, right? Wiped out that product. So I would therefore say that one should be very careful when using these products, even though I know they're liquid, they're easily tradable. You can trade them on Interactive Brokers and, pretty much every other platform out there. But you should be very cautious when implementing them into a trend following trading system that has a medium to long-term holding period, because you will be holding these ETFs for a couple of weeks, maybe a month even, right? And every time markets mean revert during that time span, you will kind of like bleed a little bit, and you would have been better off sizing the position in a different way, either through a futures contract, which has the leverage, or by using a obviously efficiently priced margin account to trade an unleveraged version of an ETF, but have a greater exposure to that unleveraged version on margin. That would do away with the compounding effect. But of course, you would have to pay for the funding that your broker charges you for that exposure. And speaking about that funding, there's a trade that I made for, that's one of the trades that, every once in a while you manufacture these trades, you see these trades, and it's outside of our trend following trading system. But probably 2015, 2014, 14, 15, somewhere around that period, right? There were a lot of leveraged ETFs launched. They kind of became really popular around that point in time. I mean, they were invented, I guess. I remember the first ones coming up probably in 2010 or something like that. But prior to 2010, those type of products didn't exist. So they came up around that point in time, and then they were picked up by the market, and more providers, Velocity Shares, together with Credit Suisse, but, also iShares and, other providers, they came up with inverse 2x, inverse 3x, long 2x, long 3x, et cetera, on all sorts of markets, WTI, the S&P, the Russell, everything really under the sun. And on some of the markets, it never worked really for me for the S&P, but I think it was on the Russell initially, right? I could be long a 2x Russell ETF, and I could be long an inverse Russell ETF. Sorry, I could be short them. I could be short them, and I would just make money through the compounding. So I was extracting the mean reversion compounding damage that these ETFs have as a byproduct of their nature. And I could make money doing that because the borrow rate on Interactive Brokers for both of these ETFs wasn't high enough or was low enough so that I could make that amount of money, right? Obviously, it required the market to mean revert. If it just trends and trends and trends, right, then I will just be, paying out the borrower to the brokerage platform and not make money. But markets did mean revert back then. And it wasn't a free lunch by any means, but it felt like a little bit of a free snack, right? Because the borrower was, 25 bips a year, something like that. But, markets mean reverting that much, I would be making a couple of percent just holding them and eventually rebalancing them to the same size. And that trade went away at some point because, markets aren't stupid and people figure that stuff out. And the borrow rate starts to adjust to pretty much exactly reflect the fair price that should be charged so that a trade as simple as that no longer works. That's the beauty of markets, right? They are just efficient in that way. It doesn't happen overnight. It takes a couple of months and boom, that trade is gone. I think you can still do that trade today, but you need to be in a very sophisticated professional trading setup with super low commissions, a broker that, where you get very low borrow fees and these type of things. And then I think the trade is still on the table, probably with a relatively thin P&L expectation, but it is still there. But for retail type of like Interactive Brokers, Schwab, whatever brokerage account, it's probably no longer available, and I stopped looking at it. But it's kind of like a walk down memory lane because I touched these leverage ETFs, but I did do it for a different reason. I traded them in order to extract that element from them. I didn't use them for a trend following trading system, and I wouldn't recommend doing it.
Yeah, I remember somebody a few years ago, probably about the same time, saying to me, "You must do this trade. You must do this trade." Yeah. And I never got round to it, and I really regret it now. There we go.
Yeah, it's no longer there, I think. And then I don't want to make this a monologue, but the Kelly Criterion, I mean, this is just this amazing story, right? I mean, Kelly, but then also, the person actually putting it into practice and using it at Thorpe in the 1960s/70s. I forgot exactly when that was, right? But in the casinos in Las Vegas playing blackjack. So the Kelly Criterion, what it does is it allows you to find a mathematical bet size or trading position size, right? That prevents you from going bankrupt. It avoids the risk of ruin, or it sets the risk of ruin to zero so that you don't overbet. But it does come with one very important requirement for it to work, and that is you need to know the probabilities. So in blackjack, when you count cards, you know the probabilities. You know exactly what they are. You know whether they are 51% or 52%, depending on whether the deck is hot or cold. But in markets, you do not. So the Kelly Criterion would be something like, it's the win probability minus, I think, 1 minus win probability divided by the win-loss ratio. And then when you play cards or you play any of these games of chance where you have a defined distribution and you have defined probabilities, then you have an exact definition of what the bet size is that you should be putting on. And when you do that, you don't go bankrupt. But in markets, it's impossible to say that I have a 60% probability of making money in anything. I could, look at the distribution, like my sample size of trades, and say, I have a win rate of 39%, and I have, therefore, 61% losing trades. I also know that I do win more with my winning trades than I do lose with my losing trades. So I have a very loose statistical representation that I could put into the formula. But I'm also cognizant of that fact that that distribution isn't stable. It moves. It moves with every trade that I do. And, every year can be very different. I sometimes have years where, I have a substantially greater win rate. And sometimes I have a substantially lower win rate than 39%. So this to me, and I looked at the Kelly Criterion as well, but this to me, this dynamic and that instability of my probability environment with regards to trades and the noisiness of markets and just markets continually surprising you, like every year there's something going on that distorts these probability calculations and that, kind of like doesn't make it stable. I therefore stopped. I never used Kelly. I researched it, I examined it, but, to me it was like, it's not applicable here. I cannot work with that formula, simple, clean formula with, defined probabilities in an environment that doesn't have defined probabilities, where every once in a while something happens. We've talked about that person who has a fable for birds. Every once in a while something happens that, is completely out of the box, oil negative. There you go. What's the probability of that in 2019? Somebody asked you, what's the probability of oil being the May contract at -40? Every one of us says 0. It's absolutely 0, even though we shouldn't be saying that, right? We should always, as quants say, well, it's probably pretty low. Nothing is really 0, but it's 0.00 something, right? I mean, you come up with some number. But at the end of the day, the market surprises you and you get kicked in the teeth because it's at -40. And in such an environment, I don't want to bet size anything with Kelly because it might get me completely wrong.
Okay. I can't allow this to stand, Moritz, go on this attack on Kelly, so I'm going to have to jump right back in there.
Of course, I expect nothing less. This is why this is fun.
So there's an econometrician, I think George Box, who said all models are wrong, but some are useful. And to me, the Kelly is an example of a model that's wrong but useful. And it's not wrong because the maths is wrong. It's wrong because the assumptions that lie behind it are wrong, or at least an approximation of reality that isn't really true. I think there's a lot of models in finance like this. There's the capital asset pricing model. There's the Black-Scholes model even, actually. And, they're models which make a lot of assumptions about the world that aren't true, but I still think they're useful to have in your toolbox as long as you know how to use them safely. So I would never use Kelly kind of out of the box, totally raw, without making any kind of adjustments to reflect the fact that, as I said, it's a model that's mathematically correct but doesn't reflect reality. And Moritz is absolutely right. And the key assumption is you don't really know what your winning percentage is. So therefore, you don't really know what your bet size should actually be. So there's two heavy caveats that I've talked about very briefly, but I will return to them. So the first is to absolutely say, yes, I'm going to have some estimate of what my performance is likely to be, but it is an estimate. And it has an estimate, but actually I have some nice statistical tools I can quantify the amount of uncertainty in that estimate. And that allows me to use an estimate for my performance that's substantially lower than what the kind of backtest would say, the raw backtest number would say. So it might be, for example, that my backtest has a Sharpe of 1. When I look at the statistical uncertainty of that, it tells me actually your mean expectation of your backtest performance is a Sharpe of 1. But when you account for uncertainty, and you look at a sort of level of performance you can be a bit more confident about, really you should be using maybe 0.6, something like that, which would translate into a Kelly of 60% of risk-adjusted, a standard deviation target a year rather than 100%. And the second thing is again, to Moritz's point about the black swans, the fat tails, the unlikely events that never happen but do seem to happen, even when we don't expect them, especially when we don't expect them, is to always make sure that your position sizing accounts for the fact that returns are not Gaussian. And especially in things like, the VIX, your tails they're just astonishingly fat, and you need to be really careful about just assuming you can use a simplistic standard deviation as a measure of risk of those things. You really can't. You need to make sure that you can survive an extreme event. You can do it quantitatively using the black swan factor I already discussed, or there are other ways of doing it. I mean, the best protection against this is diversification. If 50% of your portfolio is in the VIX and you're using Kelly sizing and your risk target is kind of something quite high, like maybe 50% a year, you're going to get wiped out at some point in the next couple of years. I guarantee it. I absolutely guarantee it. If, on the other hand, you've got a portfolio weight in the VIX of, say, 5%, and you've got a risk target that's kind of more in line with what I use, say, which would be 25% a year, when the 100% rise that we talked about overnight happens, it's going to knock a couple of percent off your performance. But it's not the end of the world, and it's a survivable blow. And that's mainly coming from the diversification effect. So I think it's a bit harsh to just throw the whole thing out, because I do think it's a way of thinking about risk that's useful. It's a useful mental model for me. I find a lot of nice intuition about the way the model works. I would never ever use kind of a full Kelly bet sizing. Absolutely never ever. But I do think it's useful for me to look at that and say, if nothing else, is a kind of upper limit on how much risk I should be taking. Because I know if I'm getting anywhere near full Kelly, I'm almost certainly getting way too big. But just because a model is wrong doesn't mean it's useful. Going back to my earlier point.
No, it is interesting. I mean, I think we're all aware and all probably old enough and grown up enough to completely understand and cognizant of the fact that any financial model that we've been using as traders, especially derivatives models, right? They are models, and most of them are actually for the trash can, in my opinion. The more I look at them, and the more I reflect on the stuff that I've been using over the years, it's kind of like that's really all BS. Just markets don't work that way. Somebody came up with that model and has a following because of it, and just everybody uses it, but they're just wrong. Actually, I recommend people have there's Paul Wilmot, a really cool, really good UK English mathematician who probably 25 years ago or so started publishing the Wilmot magazine. And it's a lot about financial mathematical modeling, derivative models in particular. And he came around, if you listen to a couple of podcasts, all of that stuff that we've done, I mean, it's intellectually interesting. But in practice, that stuff is outright dangerous, because it gives you a sense of knowing something that is unknowable just because you're using that model. And the only thing, I mean, look, we're all doing things in a slightly different way. And I have nothing against anybody using a half Kelly or, a version of the Kelly Criterion like Robert is doing, saying, well, I do know that market returns are not Gaussian, therefore I must not go with one Kelly, because if I did that, then I'll be carried out. I would have too much risk on, because it doesn't account for the tails of the market, right? And the way that I looked at that is if I do my position sizing using a half Kelly or any fractional Kelly, and then I turn around and do it the way I do it today, which is based on average true ranges, right? On a market by market basis. And this is real simple. This doesn't require a model. It just requires a calculation of the average true range. And it requires you to have a risk preference of how much is it you want to risk. And so my question to you, Rob, is, I mean, when I did it, I kind of get the same results. Like when I do my ATR-based sizing of the portfolio, over all these trades, thousands of trades done in the same way, it creates a chart. And then when I do the same thing and I do it with Kelly, of course it's going to be slightly different. But we're not talking like we're in a different stadium here. It's not a different thing. It's still it's still kind of like the trend following returns that I would expect. And so therefore, Occam's razor, I go with the simplest possible thing that has the least amount of expectations, the least amount of input and calculations that I need to put in, and the least amount of me making any assumptions as to whether I should be using half Kelly or 0.6 Kelly or 0.4 Kelly. And, this is not a critique to anybody using the Kelly Criterion. I just, to me, I turned around and thought, well, let's keep it simple and go back to ATRs. No reason to change it.
Yeah, I mean, the thing is, what you're doing and what I'm doing isn't really that different. ATRs and standard deviations are both measures of risk based on the recent daily returns of a market. And because they're both single parameter risk models, they are both effectively, one explicitly, one implicitly, assuming that the returns have some sort of standard distribution. And I actually did a blog post where I said, what is the relationship to an ATR and standard deviation? Because it is quite interesting. And basically, you can't actually say mathematically, given what the ATR is, what should the standard deviation be? Because the inputs they use are slightly different, obviously. So ATRs are using bars, standard deviation is just using closing prices. So what actually influences the kind of ratio between them, if you estimate them both for the same market over the same time period, is the amount of kind of intra-bar volatility, effectively. So there's autocorrelation patterns. But I did find empirically, interestingly, that the standard deviation of a market in price return space, it's not percentage space, because in price return space, was, I think, 0.9 of the ATR. Maybe it was the other way around. So actually, interestingly, they came out to be fairly similar numbers, although there was a definite bias that one was slightly lower than the other. So, yeah, I don't think there's a big difference. And some people, I mean, to me, actually, standard deviation is simpler than ATR, to be honest with you. So what you find simple, I find a little bit weird, and vice versa, I guess. But you're right, fundamentally, they're both essentially single parameter risk models, which therefore are making some assumptions about the distribution. And as long as your kind of risk target, either explicit or implicit, is similar, they should produce very similar results. We're kind of really in it's like two people who fundamentally are from the same kind of branch of religion, kind of arguing about whether the priest should wear a white robe or a red robe. And, wars have been fought in the past over this, but actually the difference really is not that big or that important, to be honest. Fundamentally, you're making some assumptions about the market. You've got some rules that are fairly simple. We can argue about whose rules are simpler, and they will produce positions that are probably sensible as long as you're not, your risk target's not too insane. Because it's quite possible to use ATR risk sizing and come up with positions that are way too big. And it's quite possible to use standard deviation risk targeting and have the same problem. And that will happen if you naively use the Kelly criteria. I wouldn't say that's a fundamental weakness of either methodology. They're pretty similar at the end of the day.
No doubt that assumptions are important, building models. God forbid people still build models thinking that markets are efficient, so we don't want to get into that little debate. I want to respect our listeners' time, since we're already... And we're already gone an hour or so, and we still have another question and maybe another topic. So let me jump right on to Chris's question that came in this morning. Chris writes, I've been working on my own system for a number of years. I'm most confident that I will be able to follow the system through the good times and bad. I've come to realize that a lot of trading/investing is being able to stick with the process or system. That said, I have a comment, maybe even a question. I'll use silver as an explanation because it is the futures contract that I'm having the most problems with. Using a 20-day ATR of 1.16, a minimum fluctuation of 0.005 of the dollar value of the minimum fluctuation will get you daily movement of about $5,800 per day. My thinking is that I would like the dollar movement per day to be about 0.5% of the account value. That would mean an account value of $1.16 million, which is a little too high for me. I know that silver has a mini contract, but because of your great podcast series, I don't feel comfortable trading it. Its daily volume is less than 75 contracts, and I wouldn't be able to trade too many contracts with that little volume. It is because of the podcast that I have switched to using volume as opposed to open interest, and it makes complete sense. So my question, I guess, is my thinking too conservative, too aggressive? Am I missing something? So, ATR expert, Moritz?
I mean, it's ATR, it's silver, which I don't trade. So, Moritz, this is definitely in the ballpark.
Well, I didn't pick up anything that he might be missing. I think the thinking there is correct. He's looking to size the position in relation to the account equity, and he has a certain amount of risk that he would like to take. You could do it with that mini silver contract, which I personally don't trade either. But if it is not liquid enough, if it trades 75 contracts, then it's probably not a market that you should be trading, because it just isn't enough liquidity for you to trade it in an efficient way. But I didn't pick up anything that's wrong with the thinking. Maybe you need to find a different market and not trade silver, and find futures markets that have a smaller notional value, but still get a diversified portfolio. It is possible. There's nobody saying that a trend following trading system must include silver. If it doesn't include silver, it's not a trend following trading system. Sometimes you have to do without if this is what your account allows you to do.
Yeah, I mean, I just had a quick look. I trade gold, and I think that has a cash vol, which is about a third that of silver. And obviously those two are going to be pretty correlated. So,
and there is a gold mini and a gold micro contract. And I think as far as gold is concerned, I'm not sure, but I remember I once looked at them, and those smaller contracts I think are liquid. So you could get some exposure from gold, but obviously gold and silver aren't the same. Sometimes they, behave like brothers that like each other, and sometimes they hate each other, and they do completely different things.
Yeah. I mean, this is the perennial problem for people with smaller amount of capital, which I've returned to again and again because, relative to you guys, I'm now trading with a lot less capital, and you just can't trade everything.
Yes, and but one point of that, I think there's probably two ways of going about that, and one would be to say, I will go into the micro and the mini contracts, which by the way do exist, right? And some of them are less liquid, and it's kind of like you have to just accept that fact. But then you could trade more markets and get more diversification in that trend following portfolio. Or you say, I'm just fine with trading a smaller number of markets. I mean, there are CTAs out there that trade 25 markets, and they've never increased the number of markets to more than 25, right? And they are more rough, I guess, right? They're certainly not as diversified as a portfolio of 55 or 60 or 80 markets, but still 25 markets. If you pick them cleverly, you get some good diversification benefit out of that, right? There's going to be some bonds, some FX, some equities, some currencies, and pick them from different regions around the world, and you'll get some diversification. Like I said, I think it can be done in a better way, but there's nothing wrong. I mean, really, it's okay to trade a trend following trading system with 25 markets. It would be better to trade it with 40, but it's not impossible to do it with 25.
Yeah, I think we should title this episode Groundhog Day, because we've done vol targeting, we've done how many markets you have in your portfolio. So it's things we've talked about before, and a point I'm not sure I've made before, maybe I have, but for me, if I look at things like the micros and the minis, I trade the mini S&P as it happens. That's probably now more liquid than the big contracts.
It is, since many years, yeah.
Yeah, but often when you step down to the micros and the minis, because the contract size is changing, the trading costs will increase, basically, on a risk-adjusted basis. And so you have to probably then trade them more slowly than you could the full-size contract. So you've then got a choice, essentially, to reframe what Moritz said, between either losing diversification across markets or losing diversification across time. And, probably my gut feeling is that normally it's better to have diversification across markets. That's a more valuable thing to have than diversification across time, because it does give you more diversification. So assuming they are liquid and assuming they're not really expensive, then it is probably worth looking at these micros and minis. And it's probably worth revisiting it every now and then because, the micro S&P got launched, I think about 3 years ago. And to begin with, it was definitely not liquid enough. But now perhaps it's worth revisiting it and seeing if the liquidity is improved because, futures contracts get introduced and the liquidity to begin with is normally very poor and then over time will hopefully go up. So it is worth looking at these things again.
Sure. I want to shift gear before we wrap up today's conversation. And I'll put it in a little bit of context because Rob actually sent a chart to Moritz and me before we started recording today of 3 different systems with 3 different speeds that I want him just to talk a little bit about because actually the chart is a bit surprising to me. But anyway, before we jump into that, because the topic is about speed and therefore short-term trading systems versus medium-term versus longer-term. But I did pick up a little bit of chatter this week that some participants in the markets have noticed and maybe are a little bit concerned about the rapid growth of certain managers in the short-term space. Clearly, short-term has been a good place to be. So performance has been fine, and it's been correlating very well with what's happening in equity markets. And of course, what we often see is that good performance will be followed up by large asset flows, at least to some managers. So it was interesting to me that there was a little bit of chatter about we need to be careful not seeing too much inflows into the short-term space following the success that it's had, at least up until end of August. I think September was a bit rough for short-term managers as well. But Rob, what you did a backtest here of some different speeds, I have to say it surprises me to see the difference in performance between short-term being pretty much negative since 1985 until now, even though there was a bit of a pickup in March of this year. And then on the other side, you see some very nice upward sloping performance numbers from medium-term trend models and fast trend models. Tell me a little bit more about this and if you have any guess as to why it looks so dire for the short-term model.
This is where we really should be doing a webcast, not a podcast, Moritz, because then, we could see the chart. I'm going to now have to try and describe a chart verbally, which is never easy. But also we'd be able to see all Moritz's monitors that he has behind him and how handsome you are, Niels. Many people don't realize that your caricature on the website just doesn't do you justice. So maybe we should think about, diversifying into video. I don't know what you guys think.
What did you have for breakfast, Rob?
I'm not sure. I'm not sure it's just the breakfast that...
Too much coffee. So seriously. So I did a really simple back test. It was actually for another presentation someone asked me to do. And what I did was just take 3 pairs of moving average crossovers, a couple that were pretty quick, a couple that were kind of medium speed, and a couple that were pretty slow. So in terms of holding period, maybe think about the fast bucket having a holding period of a few days, the medium bucket being kind of in the weeks region, and the slow one being kind of probably into sort of a few months. And the medium and the slow actually have had, and this goes back to 1970, which is when my data set starts. The medium and the slow have pretty, reasonable, consistent performance the whole time. The fast does pretty well until about 1985, 1990, I think it is. And then it kind of levels off and goes flat. And then obviously when you take costs into account, because of the fast is trading quicker, it costs more money to trade, the costs are higher, you basically see a pretty steady negative slope. So for the last, so what would be back to 85, the last 35 years, the medium and the slow have done reasonably well. Obviously trend following goes in and out of fashion, and there's been periods when it hasn't done so well. But the fast has consistently lost money. But then there's this really noticeable spike in March of this year, and it really just stands out on the graph as a real anomaly. And it just was kind of very striking how probably the first few months of this year would have been the only time when this particular implementation of fast trend following would have been profitable. So yeah, it was that was the sort of striking part of the image for me. But I guess the wider message is just when a strategy that's had a long track record like trend following does have a bad couple of years, it is sometimes helpful to kind of zoom out and look at that long-term performance chart and say, yeah, well, we've been here before and it has come back. if it consistently made money every year, it would be a 2.5 Sharpe ratio strategy, which it clearly isn't. And then probably a more crowded market.
I mean, there's no doubt that your chart is showing a few periods where the medium and longer term performance has been flat for, even for 5 years. And that's probably what we've seen now also in the last 5 years. Not a lot of managers have really made money. But as you say, this is not unusual. That's just part of the game. And Morris and I actually did a segment on this last week when we talked about some of the sectors and some of the markets that have caused this. Things like currencies have been pretty awful to trade, at least the way we traded for the last few years. Equities for the last 2 years has been pretty bad, pretty rough. And I think even some of the grains have been quite tricky in the last few years. So that's part of the game, and that's why we diversify, because we've had other things in the portfolio that have done okay. I am surprised a little bit, but I take your point about cost and all of that. And admittedly, I can really only think of a few short-term managers that have done well for a long period of time. And as I said earlier on, the danger is that you suddenly see an influx of money into these strategies and then they start to perform poorly. So how should I put it? The humbleness of a manager to know when to say stop in terms of inflow is really important if they want to maintain their historical performance. And it is rare. It is rare that you see people actually sticking to it. Interestingly enough, a little bit away from the CTA space, I did hear an interview with, I think it's Paul Marshall of Marshall Walsh, the very large, I think largest European hedge fund of about almost 50 billion.
Marshall Wace.
Marshall Wace.
Correct you. Yeah.
So Paul Marshall was talking about part of their success, and actually what he was mentioning specifically was the fact that on many occasions, not only had they closed their funds, they'd actually sent money back to reduce the size, and then found other ways, other products to then build the overall size of the company. But on a strategy by strategy level, part of their success was the fact that they never allowed the strategy to overstep its capacity. And I think that's a very, very valid point. And unfortunately, we see examples of the opposite happening more often, I would say.
We're not going to name names, though, are we, Niels?
No, we're not going to name any names today. Although we have to be careful with you and all that coffee. You might spill a few beans here.
Another example of a manager that's closed a long time ago on the most successful fund, of course, is Renzek, our friends at Renzek, who basically followed a similar approach, which is to not take money in the successful strategy and then launch a whole bunch of other things to diversify.
Yeah, I have mixed feeling about that approach because they've kept all the good stuff to their employees and themselves and kind of left the public with a slightly different product. So I have mixed feeling about that, but you can't take anything away from their success, of course. But there are different ways of dealing with capacity, I guess. Yeah. Any final thoughts, guys? Or maybe you want to think about it for a second. Let me just quickly run through. There has obviously only been 2 trading days of October so far. And one of them, we don't even have specific numbers because we don't see them until Monday. But as of Thursday, at least, slightly down beginning for the BTOP 50 index, down 23 bips, down 1.6% for the year. The SocGen CTA index was flat the first day, but still down 3.3% for the year. Trend index was flat on the first day of the month, down 2% for the year. Short-term traders index was slightly down, up 2% for the year. The SocGen Multi-Alternative Risk Premium Index, which is a bit of a mouthful, down 50 bips for the beginning of October, but still down 13.25% for the year. MSCI World Index was down, and this is actually as of yesterday, last night, Friday, down 20 bips so far this month, and flat for the year. Government bonds so far this month, also pretty flat. Anything else that you want to bring up before we wrap up?
Yeah, I'm going to now use my powerful computer to re-optimize the correct amount of coffee to drink before the next podcast. So I think that's probably the best use of my time now.
I have one thing. Next time we have Rob on in about a month's time, there's one thing that maybe we can discuss about the ATR versus volatility calculations. There's, I believe, one small shortcoming of an ATR calculation vis-a-vis vol. and using the standard deviation of log returns. But I'll send that to you, Rob, and then we can bring it up next time we're together on the show and speak about that detail, which I think is an important detail, which many people overlook. And it is important in a single instance, but it becomes smoothed out and very unimportant over a larger portfolio of markets and when you repetitively use it. But I'll keep the tension for that. We'll do that in a month's time.
I was just going to say, what a cliffhanger to end this episode on. And by the way,
we should do cliffhangers more often.
By the way, Rob, you might in your next simulation of coffee, you might also want to throw in decaf just to see
whether that might work. Decaf as well.
Yeah, could be just that does the trick. Anyways, thanks, guys. Great conversation. Of course, to all of you, as you can hear, we do dive into pretty much detail when you send in your questions. So keep doing that. info@toptradersunplugged.com is where you would send those to us. If you haven't left us a rating and review, if you still feel like doing that after today's conversation on all sorts of funny topics, please do so. They do help, and we do read them, and we do appreciate them. From Rob, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week. In the meantime, stay safe and be well.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.